Hello and welcome to the February CUNA Economic Update. I'm Jordan Van Ryn, Senior Economist at CUNA, and just want to start by thanking once again our new sponsor, Co-op. They've been a wonderful partner of CUNA and we very much appreciate their support. So let's get started. And I'm going to start with just a brief overview of the economy, some indicators we're looking at currently at CUNA this year in terms of the recovery. And then I'm going to share a little bit about a recent evaluation we did of a couple of different Hispanic outreach programs by Coopera and Inclusive and some interesting results from that. But let's start by looking at U.S. economic growth. This is the percentage change in gross domestic product, or the sum total of all goods and services produced in a year. And you can see, of course, the pandemic had a devastating impact not only on our health and well-being, but our finances as well. The economy shrunk 3.5% last year. There was a record decrease in the second quarter, but we do expect a relatively strong rebound. You can find our most recent forecast from February on our website at cuna.org/economics. But you can see here we have GDP projected to grow about 4.5% next year and then 3.5% the year after that. There is a lot of pent-up demand in the economy, and as vaccinations continue to roll out, people are going to be eager to travel again, go back to restaurants, and there's also a lot of stimulus money in the economy, as well as another $1.9 trillion proposal from the Biden administration, which we expect to come through probably in March or April. The unemployment rate, of course, rose to a post-depression record of about 15%, close to 20% if you take into account statistical adjustments. So incredibly high unemployment, but fortunately that has come down relatively quickly to about 6.3% through last month. So here are the top 5 indicators we're watching and we think credit unions should keep an eye out for in 2021. The pace of COVID-19 vaccination, of course, labor force participation, consumer confidence, inflation, and interest rates. So fortunately, the pace of vaccination has really picked up. And you can see here through mid-February, we're already averaging over 1.6 million doses per day. Something like 4 to 5% of the U.S. population has already received both vaccines. So really good progress so far. Of course, Dr. Fauci and others expect that we need to get to about 70% vaccination before we really reach herd immunity. And at some point, of course, you can imagine that this trend is going to decrease when we get to a certain amount of vaccinations. There are many people like children that we don't even have vaccinations for yet, folks that are harder to reach, and of course many people who may not want to take the vaccination as well. So promising signs, and hopefully this will continue. The second indicator we're really looking at is consumer confidence. Consumers, of course, make up about 2/3 of the economy in the US. And during recession periods, scary periods, consumers tend to pull back on spending and borrowing. You can see consumer confidence drop pretty precipitously here at the beginning of the pandemic. Not as far as during the Great Recession and financial crisis, interestingly, but still a pretty significant drop. It's rebounded a little bit since then, but kind of jumped up and down with news on the pandemic and, of course, the storming of the Capitol as well. As consumers start to become more confident, we expect them to spend more, start to borrow more, and to see things like auto loans at credit unions come back a bit. Now, we talked about unemployment, but perhaps a better indicator of the health of the labor market is labor force participation. This is the percentage of adults working or looking for work. And you can see that it was about 63% prior to the pandemic, down from a high in the 90s of about 67%. But it fell incredibly to about 60%. It's come back a little bit, but actually in the last couple of months has dropped again to 61.4%. This is the lowest you can see it's been since about the 70s, when many women came into the workforce. And this is really due to a number of factors. Of course, a lot of parents, particularly women, are staying home with their children, doing virtual learning. A lot of people may be staying home and out of the labor force just out of fear of getting the virus, particularly at-risk folks. So you can see, even though the unemployment rate is relatively low, the labor force participation rate remains quite low compared to pre-pandemic levels. And you can see even folks like Jerome Powell, the chairman of the Federal Reserve, said recently, if you take this into account, the unemployment rate is really probably closer to around 10%, in fact. But a lot of people aren't even looking for work, so they're not included in the official unemployment rate. A lot of people are worried about inflation. You might have heard Larry Summers come out recently, express some concern about this. With all of the stimulus going on and a recovering economy, it's possible we get some temporary inflation. And you can see we do forecast about 2.1% growth in the consumer price index this year and 2.3% next year. This is still relatively mild, especially compared to the Fed's preferred measure of personal consumption expenditures. So we expect maybe some temporary inflation, but don't expect this to be a major concern where you have kind of spiraling, growing inflation that's out of control anytime soon. However, inflation, of course, does affect interest rates, so it is something to keep an eye on. And interest rates are our last indicator here, something to keep an eye out for. Both long and short-term rates you see here. A long-term perspective, which I think is interesting because you can see the long-term decline in both short and long-term interest rates. And economists argue about why this is, but many economists believe that this is due to changing demographics and just a lot more savings among particularly elder populations all around the world as well. Other countries saving more in US dollars. Also, there's just a lot more kind of online shopping and better risk management. All of those things tend to depress interest rates. And so you see the Fed funds rate is now basically at zero, and the 30-year fixed mortgage rate has come down to record lows of near 2.5%, which is pretty incredible. And that's really, of course, driven a big increase in home prices and mortgage growth at credit unions as well. That's something that's very different from the last recession when, of course, many people were underwater on their homes and couldn't make use of that equity. All right, now let's go on to an evaluation of Coopera and Inclusive, some of their Hispanic outreach programs. Myself, along with Samira Salem and our data analyst Paul Hellman, did a recent evaluation of these programs to try and see what was the impact of Coopera's Hispanic Outreach Program and Inclusive's Juntos Avanzamos designation on credit unions' growth, earnings, and asset quality. And basically what we did is we used statistical regression analysis, and we compared credit unions that joined Coopera's program or Juntos Avanzamos' program to otherwise observably similar credit unions that did not join before and after joining. So we have kind of a control group and a treatment group there that we can compare. And you can find more details about their programs on their websites, but Coopera's Hispanic Outreach Program basically helps credit unions learn how to better outreach to Hispanic populations, and Inclusive's Juntos Avanzamos program gives credit unions a designation if they meet certain requirements to be able to be more friendly and inclusive of Hispanic populations. So both of these really focus on reaching out to Hispanic populations. Now, why is that important? Well, as you're probably aware, there's tremendous growth in the Hispanic population in the United States. In fact, about 56% of the population growth from 2000 to 2020 was due to growth in the Hispanic population, both through immigration and the birth rate as well. So it's estimated that by 2025, roughly 20% of the population will be Hispanic, by far the second largest ethnicity after whites. So for credit unions, this is particularly important because, unfortunately, as a whole, the credit union industry has not done a great job of reaching out to the Hispanic and Latinx community. You can see overall about 18% of the population is Hispanic or Latinx, but only about 6.3% of credit union members. Banks don't do much better. They're also much less compared to the national average at about 10%, but they do a little bit better than credit unions. credit unions do relatively well with the Black and African American population, actually serving a higher proportion than the national average. And of course, whites as well, they serve a higher proportion, similar to banks. So I'm going to show you a few graphs that look like this, and basically the idea is that this dotted line represents when these credit unions joined the program. So this is 3 years before, 2 years before, 1 year before, and then we expect to see an effect maybe 1, 2, or 3 years after joining the program. So for example, you can see here, this line represents sort of on average the impact of credit unions joining the program compared to those that did not, comparing after joining to before. And the shaded blue represents sort of a confidence interval, 90% confidence interval. So you can see that 3 years after joining the program, this is the effect on membership growth. These credit unions were growing about 40 to 50% faster relative to credit unions that did not join the program. And we see a similar effect on loan growth as well, perhaps even more dramatic with loan growth. There is a big confidence interval, but it doesn't cross zero, so we're pretty confident of this positive impact on membership and loan growth. For membership growth overall, these credit unions grew about 44% more compared to otherwise similar credit unions during that period following joining Coopera. So really promising results on loan and membership growth. And we don't see any impact on, this is the effect on the delinquency rate. You can see just stays relatively flat. And this is a concern we hear a lot from credit unions, that they fear maybe reaching out to new populations because maybe they're less familiar with those populations. They don't know how to underwrite those types of loans. But fortunately, we don't see any negative impact on portfolio quality, both in terms of the delinquency rate and if we look at charge-offs as well. In fact, if anything, there's seems to be a positive effect that decreases net charge-offs, although this is also not statistically significant. And then finally, we don't find an impact on earnings. Again, here, this could be positive, if anything, but not statistically significant. However, this is just a short-term look, only up to 3 years after the program. We don't have enough data to look at longer periods, but it's quite possible, of course, that there's a positive effect on earnings later on, maybe after 5 to 7 years. For earnings, there's kind of a couple of different things going on. Of course, credit unions need to invest in these programs, which takes some expense, so that puts kind of downward pressure on earnings. But hopefully over time, the additional loans and members will increase earnings. So overall, we find these programs tend to increase membership, loan, and asset growth, which is very positive. I showed you the results for Coopera because we have a little bit better data for them. But generally speaking, the results were very similar for Inclusive's Juntos Avanzamos program as well, which I think is very promising for these programs overall that reach out to Hispanic populations. No negative impact on portfolio quality. No impact on earnings either. However, these are relatively short-term results. And importantly, we do want to emphasize that these results may not hold for every credit union. It could be that there's something particularly special about these credit unions that join these programs. They were already thinking and investing in this, or maybe they have more Hispanic populations in their fields of membership. So we certainly don't want to give off the impression that every credit union that joins these programs is going to have this incredible result. This is on average, of course, so not every credit union experienced these results. Some did a little bit better, some a little bit worse. But we do feel that these results are pretty promising. And for many, many credit unions, these types of programs could have really promising results. So if you want to learn more about these programs, you can also go to our website, cuna.org/economics. We have a policy brief on this issue, and you can, of course, also go to Coopera and Inclusive and look at more details about these programs. Thank you for tuning in to the February Economic Update, and look forward to seeing you again in a couple of months.